Okay, let's go ahead and go through the solution to that additional homework question that's associated with Chapter 5. Again, assume that on January 1st, 01, Big acquired 80% of Little Company for $400,000. The fair value of the non-controlling interest on that date was $100,000. Little's book value on that date was $350. All of Little's assets and liabilities had fair values equal to book value except land undervalued by $40,000, inventory FIFO basis overvalued by $20,000, patents 5-year remaining life undervalued by $30,000, bonds payable 10-year remaining life overvalued by $15,000, and we're going to use straight line amortization. During 2001, Little reported earnings of $60,000 and paid dividends of $20,000. Our task is to prepare all equity method entries for 2001 and all elimination entries for 2001. Okay, the first thing we have to do is our cost versus book value equals differential analysis. The cost or value, our share was $400,000, the total was $500,000. The book value given is $350,000, that's the total, our share is $280,000. For a differential, $120,000 for our share, $150,000 total. So we paid, or Little is worth more than book value, and the question now is, why are they worth more than book value? Well, they've got some undervalued land. The land is worth more than book value, therefore the company is worth more than book value. So we're explaining away part of that differential. $40,000 total misvaluation, our share $32,000. Inventory is overvalued, so we're going to go ahead and add that. $20,000 total, our share $16,000. There are some undervalued patents, $30,000 total, our share $24,000. And again, the patents are undervalued. That means that, again, they're worth more than book value, so the company's worth more than book value. So that explains away part of that differential. That's why we subtract it. And then we subtract the overvalued bonds. What's left is going to be goodwill. The total goodwill is $85,000. Our share is $68,000. Again, a couple things before we go any further. First, we need both of those columns of information. Our 80% column, those are the numbers we're going to use when we account for our investment. We own 80% of Little, so we're going to own essentially 80% of the differential assets and therefore the amortization. The total 100% column, that's the information we need to use for the consolidation. Second point, again, it can often be confusing. Do we add or subtract overvalued or undervalued assets, overvalued or undervalued liabilities? From my perspective, the easiest way to start thinking about this is by referring to an undervalued asset. Again, look at undervalued land. Land is undervalued. That means it's worth more than book value, which means the company is worth more than book value. So that explains why we're paying more than book value. So that explains away part of that differential. So we subtract undervalued assets. If we subtract undervalued assets, that implies we would add overvalued assets. That's why we add the overvalued inventory. Jumping over to the liability side, again, assets and liabilities from a debit and credit perspective are sort of opposites. So if we subtract an undervalued asset, we would add an undervalued liability. If we add an overvalued asset, we would subtract an overvalued liability. Okay, so let's go ahead and go through our equity method entries. We purchase our investment. We go ahead and report our share of Little's reported earnings. Again, they made $60,000. We own 80% of their stock. So we recorded investment income for $48,000. And dividends. They paid $20,000 in dividends. We own 80% of the stock, so we received $16,000. And again, that reduces our investment. Next, we need to do our amortization entries. And let's just go through these one by one. First, the undervalued land. Land has an indefinite life, therefore it is not amortized. Therefore, it will just sit there until it gets impaired or is sold. The inventory, however, we're using a FIFO basis. That means that by the end of the first year, that inventory will have been sold. And so we need to go ahead and amortize our share, $16,000 of that inventory differential. So we're going to go ahead and adjust our investment income upwards and reduce our investment account. Now again, it can be confusing whether we debit or credit the investment, whether we debit or credit the investment income. Let's think of this from the income statement perspective. Little's inventory was overvalued. So Little's inventory was overvalued, so when they sold it, their cost of goods sold was overvalued, which means their income was understated. Since they underreported their income, we underreported our investment income. And so what we need to do now is we need to go ahead and boost our investment income to make up for that, that misstatement, that recording of income. Next we have the undervalued patents. Again, $24,000 was our share. They've got a 5-year life, so $24,000 over 5 years will be $4,800. And so we have $4,800 of amortization. Again, the amortization is not an amortization of the patent itself, it's an adjustment to the investment income and the investment. And then finally the overvalued bonds, $12,000 amortized over 10 years, so $1,200 per year. Next we need to go through our elimination entries. And again, we start with our S entry where we eliminate first the subsidiary's beginning of year equity accounts. Now, I didn't specify how the equity is broken down in terms of common stock, additional paid-in capital, retained earnings, and so on. So let's just go ahead and call that little equity. And in addition to eliminating the subsidiary's beginning of year equity accounts, we also need to go ahead and create or carry forward the differential assets. So again, let's just go through one by one. We have some undervalued land. So we're going to, and again, now we're looking at the total 100% column. Land is undervalued by $40,000, so we're going to go ahead and write up Little's land by $40,000. We're going to go ahead and debit land for $40,000. Next we have that their inventory was overvalued. So their inventory is too high. We're going to take it upon ourselves to reduce inventory. So we credit inventory for $20,000. Next, they've got undervalued patents, undervalued by $30,000. And so again, we take it upon ourselves to increase their patents by $30,000. They've got some overvalued bonds, so we'd like to reduce their bonds payable. Instead of reducing bonds payable itself, we'll go ahead and create a $15,000 discount on bonds. And then whatever's left is goodwill. So we need to record $85,000 of goodwill. Now if you sum up those 6 accounts, they total up to $500,000. That's our beginning of year book value and unamortized differential, and that's going to be split 80-20 between the investment and the non-controlling interest. Next we need to move on to our A for amortization entries, and again let's just go down the list one by one. We've got 5 differential asset or liability items: land, patents, discount on bonds, goodwill, and inventory. The land has an indefinite life, so it will not be amortized. The patents, however, have a 5-year life, so we just created $30,000 of additional patent value, which means we need to go ahead and amortize $6,000 of that additional patent value. Again, $30,000 over 5 years, $6,000 per year amortization. Likewise with the discount on bonds. We have a $15,000 discount on bonds being amortized over 10 years, $1,500 per year, and as we all know, amortizing a discount increases your interest expense. Next would be the goodwill. The goodwill, again, has an indefinite life. We don't amortize it, we test it for impairment periodically. And lastly, the inventory. Again, just looking at this mechanically, in the S entry, we credited inventory for $20,000. Since we're using FIFO, by the end of the year that inventory is gone. So we need to go ahead and debit inventory to get rid of it and adjust our cost of goods sold downward. Again, you can try to, you can talk your way through this and say again, Little's inventory was overvalued. When they sold it, their cost of goods sold was therefore overvalued. And so what we're doing here is we're adjusting cost of goods sold downward to correct their overstated cost of goods sold. In any event, moving on to our I for investment income entry. If you refer back to those equity method entries and tally up all of the debits and credits to investment income, you would find that investment income is $58,000. We need to eliminate that. D for dividends. We eliminate the subsidiary's dividends declared, splitting that 80-20 between the investment and the non-controlling interest. And then lastly, Inc for the income to the non-controlling interest. And again, the non-controlling shareholders are going to get their share, 20%, of the subsidiary's adjusted/reported earnings. Sorry, adjusted/realized earnings. So we start with their $60,000 of reported earnings, and then we look at those A for amortization entries and we ask, how did those 3 amortization entries affect reported earnings? Well, the first one, we added $6,000 to amortization expense, so that reduces our income by $6,000. The second one, we added $1,500 to interest expense, that reduces our income by $1,500. And the third one, we credited or reduced cost of goods sold by $20,000, so that increases the earnings. So the adjusted/reported earnings, adjusted/realized earnings, 60,000 less 6,000 less 1,500 plus 20,000, 72,500. The non-controlling shareholders get 20% of that, or 14,500. And so we go ahead and allocate 14,500 to the non-controlling shareholders, and that increases their equity claim on the subsidiary. Okay, finally, I want to go ahead and again compare or reconcile this with the textbook approach, which you have no doubt noted that I am not really horribly fond of, but it's important that we sort of see that they end up being essentially equivalent. In the textbook approach, we start with what they refer to as the basic consolidation entry, and this is based solely on book value of equity, book value of income, book value of dividends. So we're going to go ahead and eliminate the subsidiary's beginning of your equity. We're going to go ahead and eliminate not all of the parent's investment income, but the portion of their investment income that came from the subsidiary's reported earnings. Again, Little's reported earnings were $60,000. The parent's share of that was $48,000. Likewise with the income to the non-controlling interest, they would get 20% of that $60,000 of reported earnings. And we eliminate the subsidiary's dividends declared. That total is going to be allocated 80-20, or in this case 20-80, between the non-controlling interest and the investment in Little. So again, this is based solely on the beginning of your book value, the reported earnings, and the reported dividends. Solely based on book values, no mention of any differential or any amortization or anything of that nature. Next we move on to what they call the excess value reclassification entry. And here's where we are recording the end of year remaining differential assets. So the land, again, the land, we had a $40,000 differential. That has an indefinite life. It wasn't amortized or impaired, so basically that still is $40,000 at the end of the year. The patents, again, originally there was the $30,000 patent differential, but $6,000 of that would have been amortized in the current year, which means there's $24,000 left at the end of the year. Goodwill, $85,000, wasn't impaired or anything, so that still just sits there. The discount on bonds, again, there was initially a $15,000 bond differential, of which $1,500 was amortized, so we're left with $13,500 at the end of the year. And notice that there's no mention of the inventory. The inventory differential existed at the beginning of the year. It no longer exists at the end of the year, so we're just going to essentially ignore it as far as this entry is concerned. So we tally up those 4 debits, and we split the total 80-20 between the investment and the non-controlling interest. Finally, we do our amortized excess value reclassification entry. Here's where we're dealing with what essentially we refer to as the A for amortization. So we're going to go ahead and record $6,000 of patent amortization, $1,500 of interest expense, and we had that $20,000 adjustment to cost of goods sold. Now, these adjustments to earnings, those accrue to the parent via their investment income and the subsidiary via their non-controlling interest in, or income to the non-controlling interest. Again, both the left-hand and the right-hand side of this screen end up giving you the same thing. It's just a different way of organizing it. Whichever way you prefer is A-okay with me. My personal preference in that S, again, as you obviously know by now, in that initial S entry, I establish my beginning of year values, and then I deal with what happened over the course of the year. I amortized over the course of the year. I had this year's income, I had this year's dividends, and I have this year's income to the non-controlling shareholders. Textbook approach just organizes it differently. Not better, not worse, just different.